Welcome everyone who is just joining us. We're going to start in a few minutes. Just want to give some folks some more time to log in. So we'll start shortly, and I have started recording so we can make this available for viewing afterwards. So we'll just start here in a couple minutes as other people get logged in. All right, well, welcome everyone. We're going to go ahead and get started. Thanks for joining us today. I'm Melinda Merk. I'm a principal with McCandlish, Lillard in Fairfax, Virginia, and I'm pleased to introduce my co-host, Marnette Myers, a principal with Prager Metis CPAs in McLean, Virginia. A couple housekeeping items before we get started. We are recording today's session, and we do hope to make the recording and slides available to everyone who's registered. We'll hopefully be sending those materials out to you tomorrow by email. Please feel free to submit questions using the Q&A button at the bottom of your screen. We'll do our best to try and get to questions at the end of the session, and to the extent that we don't answer your questions, we will try to follow up with you, or please feel free to send us an email. And let's see. So this is our agenda, and I know you all have been on probably a lot of webinars over the last couple of weeks. And so our goal today is to kind of help put things a bit in perspective in terms of what we can most likely expect going forward with which now is presumably the new President-elect Biden and his administration. I give a summary of Biden's tax proposals, and then get into some of the income tax planning considerations and potential mitigation strategies given some of the uncertainty that we still have in terms of the control of the Senate, and when we might be expecting any potential tax law changes. Similarly, we'll talk about some estate planning considerations and potential risk mitigation strategies. And then, like I say, hopefully leave some time for questions at the end. So we have a few disclaimers here. The first is, Marnette and I both feel, the sky is not falling. There's been a lot of articles, a lot of commentators. Even the end of last week, the Wall Street Journal had an article about how Joe Biden's tax increase wish list could affect you, and kind of, still pressing, especially clients to think that, we have to rush and hurry up and get, all things done, by the end of this year, because there could be retroactive tax law changes as of the beginning of next year. And we would like everyone to just take a calm breath, and we think that result is pretty unlikely, but that said, no one has a crystal ball to predict the ultimate outcome of what's going to happen with regard to control of the Senate, and then even how Congress and Biden will work together over the next 4 years in terms of all of the various items that are on the agenda, with tax law changes being just one of many. So our goal for this presentation is to really synthesize and summarize what not only our thoughts, but what other tax policy experts and other commentators have been kind of talking about over the last couple of weeks, and we still don't have the certainty with the outcome of the Senate. And Marnette's going to get into a little bit more about that. Our intent is not to express any political views or support for any one political party or candidate. Again, we're just trying to kind of project what, based on all the information that's been discussed and the experts over the last couple of weeks, what's the most probable outcome, and then how can we plan and advise our clients going forward. I did want to refer people to the Tax Policy Center, and this report was cited in that Wall Street Journal article from November 13th. So Tax Policy Center has summarized, as of November 6th, all of President-elect Biden's tax proposals. I think it's important to point out that a lot of his proposals, he hasn't really come out and expressly, stated definitively one way or another, but that report does give a good kind of analysis and likely projection, has a lot of good charts and revenue estimates. So I would refer you all to that, and we can certainly include that in our materials that we're gonna be making available to you all by email. So this is just a good summary of where we are, and I've been following this. It's from the Associated Press, and if you Google U.S. presidential election results 2020, this will come right up on your screen, and it's pretty cool because it's interactive, and you can click on each of the states, and you can then switch over to the results in the House and the Senate, and so here's where we are. You can see the only state that is still either not in blue or red, it is Georgia, and the Associated Press, the last I checked early this morning, is still not calling Georgia because I guess the recount that the Trump campaign had requested a recount, and that is my understanding that the results of that recount are to be announced today. And so the Associated Press I have found, and I've been following their reporting since Election Day, and they have been the most accurate and not rushing to report, like Arizona, before all the votes were counted. And so you can see they're being very conservative here and still have yet to call Georgia. But as you can see by the electoral votes, with Georgia having 16 electoral votes total to be awarded, that's not going to affect the outcome in terms of the presidential elect. So Marnette, I'm going to turn over to you, and you can go over some more of the election results.
Sure. Good afternoon, everyone. And thank you, Melinda, for that wonderful intro and overview. So this is a little more detailed of where we are on the election results as of yesterday. As you saw from Melinda's, I guess the AP chart earlier, Joe Biden's ahead, 290. Once Georgia electoral votes are awarded at the end of the recount, likely that will be 306 for Joe Biden. Short of any changes from any of the various lawsuits that are in play, this seems to be where we are headed. Last I looked, I believe the lawsuits were won in 27, so I don't think there's any major changes on the horizon from many of the upcoming lawsuits. But where things are really interesting right now is in the Senate. As you most likely know, we have 2 open seats in Georgia, and neither candidate got at least 50%. Therefore, Georgia hands off to a runoff election. So we have 2 seats, both currently held by Republicans, but they will be having another election on January 5th of 2021. And so that most likely will result in yet another recount, which would mean we may not know the outcome of the Senate until after the Senate is in session, which is, I believe, January 6th. So we might not even know, till late mid-January at the earliest. Right now, based on history in Georgia runoff elections, the runoff elections do appear to generally benefit the Republican side. They seem to have more of an upswing on the Republican side. But that goes back only as far as 1992, and the overall Georgia outcome as of 2020 very different than what it was in 1992. So who knows if history will repeat itself. Additionally, in states where there have been 2 seats open in the Senate, generally there's not a split. If one goes Republican, they're both Republican, or one Democrat, they're both Democrat. So that goes back, I believe, till 1900 or so. So it looks like if history holds, we'll have 2 either Republican or 2 Democrat seats in the Georgia. So that could either leave us with 52-48 or 50-50. And so at 50-50, of course, that's complete split down the line. But any even votes like that, the deciding vote is Vice President to be elect Kamala Harris. So it looks like the Democrats would have the edge at that point. So that's where we're looking at in the Senate. The House, the Democrats are retaining control of the House. However, that is much less than what they had previously, so it's a much closer race there. And there's still 9 seats unaccounted for, so that could change slightly. The biggest takeaway from the election is there was no blue wave, as many people were projecting. As I just mentioned, Democrat seats in the House, they've lost. It's much closer in the House. Senate could go either way. And yes, it looks like Biden will be taking over as president. But that's still very close. On best case scenario, Senate's 50-50. That leaves a lot of room there. You've got a lot of conservative Democrats that aren't going to necessarily jump on the Democrat bandwagon every time. So no idea what's going to happen there, even if we're at 50-50. It doesn't exactly leave a huge amount of political capital on either side. And Biden will be the first among the last 4 presidents to take office, most likely without controlling the Senate. So that in and of itself is going to make things difficult. And as you've probably heard, is we all here, a lot of us are here in the DC area, 51 votes don't not necessarily mean a bill is going to pass. You can only do that for judicial appointments and budget reconciliation. So they like to put a lot of tax things in the budget reconciliation process so they can get those passed at 51. Otherwise, you need 60 votes to defeat a filibuster. That's going to be really hard to get in this current political climate and split. So we can move on to our lovely chart of the Biden tax proposals as compared to current tax law. Now, this is where so many people were worried about, they're calling me, and I'm sure Melinda, what do I do if, Biden gets elected? I need to make a lot of moves. As we've kind of indicated, I don't think there's going to be a whole lot of huge changes, certainly not in 2020. They're not going to make it retroactive there. 2021 is going to be a hard sell with the close Senate races and House split, and still wouldn't be retroactive to 2021. That hasn't happened since 1993, I do believe. And even then, that was a tax cut. It's much easier to sell a retroactive tax cut than it is a retroactive tax increase. Voters don't like that. I don't like that. You don't like that either. So we're really looking at this as most likely going to be something that we're going to be more concerned about for the 2022 tax year. But we still need to watch out for this and see if there's any changes we want to make before then. So let's look at the corporate tax rate. Under current law, the Trump plan reduced the corporate tax rate to 21%, lowest it's been in quite some time. It's been heralded by a lot of corporations as, they're very happy with that. The Biden plan is looking to up that to 28%. And then there would also be essentially an alternative minimum tax scheme in that as well, like we have for individuals. And that would tax corporations that earn $100 million or more at a 15% on their book income. So with the coronavirus economy issues, I think a corporate tax rate hike is going to be a tough sell right now. We have a lot of businesses that are just struggling to stay in business. So to up their taxes is going to be harder in this climate. I would say that's probably something that's going to be pushed to 2022 or later. But I do think this is definitely something that Biden has been talking about, and I think it's something that will happen, just not yet. And probably not 20%. There's probably going to have to be a lot of compromise in these. So, maybe they'll drop that down a little bit and see what we can do there. So Social Security tax, as wage earners or self-employed, you pay Social Security tax, which is 12.4% on the first 137,000, we'll just round that, in 2020. There was an executive order from Trump that allowed employees to defer their Social Security taxes from September through the end of December. There was talk that that was going to be made permanent. I don't think that's going to happen. And it hasn't been something that I've seen clients really take advantage of. It's kind of been just a deferral. So it turns around, you're going to have to pay it in January. It hasn't got a lot of traction. So I don't think there's any change there. Now, in the Biden rule, he's going to keep that 137. That's not going to change. What will change every year, it's adjusted for inflation. But he looks to reintroduce Social Security taxes when your wages are over 400,000. So they've called it like a donut. So you'll have the first 137,000, then a break to 400, and then you're back in again. So what I've seen and talked to a lot of my clients about, especially if you've got an S corporation and you were paying yourself a large salary, maybe you don't quite pay yourself as large, keep it under 400,000. The thing to watch out for if you do have an S corp, your salary has to be reasonable. So if you were paying yourself 1.5 million and suddenly you're paying yourself 400,000, was that a reasonable decrease? So that's certainly something you want to talk to your tax professional about, but it's also a tax planning opportunity to watch out for. Here we've got the next is the QBI, the 199 Cap A. That was a huge change in the tax bill that came through in 2018 under Trump's plan, where it allowed some businesses to deduct up to 20% of their net income from as a deduction on their tax return. The Biden plan is a little nebulous on this. They're not saying anything too much about it, other than they're potentially getting rid of this for taxpayers who make more than 400,000. That could be a huge hit for some businesses that were able to deduct this and have pass their income of more than 400,000. That could be a big hit to some clients. So something to definitely watch out for. There's not a whole lot of tax planning you can do about that, whether it hits or not, but certainly would mean that your tax rate in bill could go up. So then we've got the individual tax rates. They all changed in 2018. The top tax rate was 37%. This all sunsets in 2026 currently, but Biden has put out that he wants to raise the top rate to 39.6, which was the top tax rate in 2017 and before. Nothing unusual for everyone there, but it would be an additional 2.6% tax on a lot of you. Again, I don't think that's going to happen until 2022, but I would think in the hierarchy of things, that's something that might happen before some others. Then we've got the capital gains rate, which is what so many of my clients were worried about. Right now, the top tax bracket for capital gains is 20% plus 3.8% for the net investment income tax. Under the Biden plan, he's looking to raise that top rate to 39.6%. That's a huge increase, and what I've had probably more calls on than anything else. Again, I don't think this is going to happen in 2021, but if you are conservative and you have a big tax bill coming up with capital gains, it's certainly something to consider. If you can do it in 2020, you want to be super safe to make sure you've got that 20% rate, is something to think about. I think we're going to have 2021 to still do that, but it's in the long run, I think it's something that's going to be looked at. Again, might just be for high tax bracket individuals. So we can look at that. The itemized deductions, right now, there's no cap on itemized deductions. That phase out went away in 2018, I do believe. The big change on itemized deductions was that, as you probably all know, your state and local income tax deduction is capped at $10,000. That hit a lot of us hard in the high real estate tax areas. The Biden plan has talked about repealing that SALT limitation. So that means all your real estate taxes are once again deductible. And that has a lot of bilateral support there on both sides. So that's something that could happen before some of these others. It would be a tax cut. So that's a lot easier to sell than an increase, as I mentioned before. The other thing is that the itemized deductions under the Biden plan would be limited to 28% if you have your high income tax earner. So that is most likely another one for down the line. And I'm just going to touch on the estate tax because Melinda's going to get into that in detail. Currently, it's 11.58 million in 2020, going up to about 11.7 in 2021. That's all going to expire in 2025. The Biden plan is looking at dropping that to 3.5 million from 11.58. So that's a huge change there. And the other change on the Biden plan is to eliminate the step up in basis rule, which would be administratively a nightmare for accountants, and I'm going to say attorneys as well. But I will let Melinda get into that on more detail in a few minutes. We've got the child tax credit. Right now it's $2,000. Phased out if you make more than $400,000 for married filing jointly. The Biden plan is looking to up that to $3,000 and $3,600 if the kid's under 6. As I like to joke to my clients, because that will totally make you whole, because kids really only cost you $3,000 a year. They look at me like I'm strange because apparently that's not true. But every little bit will help, and this will be a middle class tax cut, which is something Biden has also pushed. Better chance that this might happen before some of the others as well. Earned income tax credit, I'll just touch on. If you're over 65 and don't have kids, you're now eligible under the Biden plan for the earned income tax credit, but really doesn't impact that many people. And one thing that I didn't have on here that is not really a tax cut or anything is a change to 401k contributions. Currently, if you contribute to your 401k, that reduces your taxable income on your W-2. The Biden plan has proposed getting rid of that, and instead of a deduction, would give everyone a tax credit for contributions to 401ks and IRAs. But that would be a tax credit based at a 26% income tax rate. So if you're in the 37% tax bracket, that's not going to help you as much as the deduction would. So it's revenue neutral for the government, but it would potentially push people more towards a Roth IRA or Roth 401k. So I throw that out there as something to just watch out for.
But Marnette, something really interesting. I just thought I'd pipe in here. I'm reading over this tax policy center report, and in terms of revenue effects, when you look at what's going to get the biggest bang for the buck, it is first and foremost applying the Social Security payroll taxes to the earnings above 400,000. That's estimated to raise 740 billion. And then the second is increasing the corporate income tax rate from 21 to 28%. That's 730 billion of revenue estimated. Increasing the capital gains, the rate on capital gains and dividends for taxpayers with incomes over $1 million, 370 billion. And then you get to increasing the estate tax, as you described, 220 billion. So that kind of helps to put things, again, in perspective in terms of what's going to, really generate revenue.
The biggest bang for their buck. Yeah. Exactly. So now we're going to look at the legislative agenda going forward in this lame duck session. We've got about 60 days. I believe the Senate's already out of session until after Thanksgiving. House, I think, is about to recess, I think, later today. So going to say nothing's going to happen until probably December at this point. But one of the biggest things is the COVID relief bills and stimulus plans. The House has had a bill passed, I think, the HEROES Act, which has been out there for months. Senate hasn't moved on that yet. The Democrat-backed plans are looking at about $2.2 billion. It's a much broader stimulus and relief plan, where the Republicans are looking at smaller targeted bills, about 650 billion, just small 650 billion. McConnell has looked at an even smaller plan of about 500 billion, which is what he was proposing. So there's a lot of push for everybody. Everybody would like a new COVID-19 relief and stimulus plan. There's really a lot of, overall support for having something. However, nobody seems to be working together quite yet, but I think December might be the time to do it. We've got a lot of businesses. I know I've talked to a lot of small businesses, and they're not sure they're going to make it, if they don't get something soon. So I think that's going to help spur on some action with these. Another issue is the PPP, the Paycheck Protection Program. If you pay expenses with those funds and those funds are forgiven under that plan, currently you can't deduct them under the IRS rules. That was not how Congress intended it to work. It was supposed to be completely kind of tax-free, but that doesn't work with IRS rules. So we need congressional action on that. That has some support on both sides. So I think that's something that could be coming up. The IRS did just issue a revenue ruling and a revenue procedure last night at I think 6 o'clock, because why do it during the day? Which basically reiterated some of those rules and also put out some rules for what if you have forgiveness, but it doesn't happen before the end of your tax year. And so that's something to watch out for. However, it's a very fluid situation with PPP. I anticipate we're going to see several more revenue rulings and procedures and some congressional action. So it's by no means set in stone at this point. Another thing that they need to look out for is an upcoming funding bill. Current resolution expires December 11th. So Congress either has to pass a full-blown budget or another continuing resolution, or else we have another government shutdown, which if we all recall, I think just happened not too long ago, and I don't think anyone wants to deal with that again. So I anticipate we're going to have a continuing resolution. Doubtful we'll have a budget by December 11th, but I've been wrong before, so we can all be hopeful. Then there are some options out there with have support from both sides. Infrastructure, which is always touted as support from both sides. So I think there's that's something that could happen. But again, we've only got the month of December essentially before something to happen. So while I'm hopeful, I'm probably thinking nothing's going to happen other than certainly a budget, some type of budget resolution with and let's hope for some COVID-19 relief.
Marnette, we're all optimistic, and particularly as the last bullet notes there, Biden and Senator Majority McConnell do have a long history of working together and negotiating, and so hopefully we won't see complete gridlock, and we can actually see some progress and some bipartisan agreement.
Yeah, I completely agree. And I think the fact that, Congress, the House is going to be really close. There's not a huge, majority on either side. The Senate at best is 50-50. I think that's going to force some collaboration and negotiation. And I'm hopeful that we'll get some stuff done soon. So I kind of touched on most of this stuff already. There's most likely this, nothing's going to happen until later in 2021 at the earliest. Good chance they could just punt this to 2022 with the new elections in 2022 year. But this is certainly something we're going to watch out for. I don't believe there's anything really, Melinda, let us know that, the corporate tax rates would bring in the most money, but it's also going to have a huge impact on businesses. So, this might not be the right environment for something like that to happen, but certainly 2022 is always just around the corner.
Yeah, and I agree with what you said, Marnette, about the elimination of stepped-up basis at death. It's been considered, and it was actually temporarily a modified carryover basis regime we had in 2010, but very unlikely that we would see that pass, just like you said, just due to the ultimate nightmare and difficulty and trying to track whatever the original basis might be.
Yeah, I had, I think, one client in 2010 that did the modified step up. So it was not fun. And I believe the IRS essentially audited every single one of those. So I don't think that much of anybody is backing that other than, as a way to raise revenue.
Yeah, but the capital gains tax at death could be certainly easier to administer. And So that's something we'll be keeping an eye on.
Sure, absolutely. So, and then this is just, I just talks about, things that could happen with under executive order. A lot has happened in the Trump administration on executive order. I anticipate the same thing under Biden. I assume you do too, Melinda. There's a lot
Yeah.
out there.
I mean, certainly this is the opportunity for the executive order, just as we've seen with the last two administrations between Obama and Trump, to put forth some more of the progressive democratic initiatives with regard to the environment and immigration, social justice reform, and the overall kind of view of racial and wealth inequality, which does tie into tax policy. And there is the ability to undo the regulations under the 2017 Tax Act where there's ambiguity. You certainly can't increase tax rates through executive order, but another way to try and get some democratic initiatives through that would otherwise not be able to make it through Congress.
So now this is just a little recap of some key changes in 2020, just to keep in mind. The standard deduction is adjusted for inflation, so we're up to 12.4 and 24.8 for married filing jointly, plus some additional if you're over 65. You've got your IRA and 401k contribution limits of 19.5 and 6,500. That's for 2020 and 2021. Those amounts are not changing in 2021. Same for your IRA contribution, 6,000 and 1,000 if you're over 50 for the catch up. Again, same for 2021 as well. Probably they'll hit the inflation adjustment figure in 2022, but we'll see about that. Then we've got one of the big changes in charitable contributions is one of the big things we've seen in 2020. So if you're taking a standard deduction, previously you got no benefit for your charitable contributions. Now you can get a $300, it's not much, but it's something, above the line deduction. So keep track of that. If you're a standard deduction person, you can at least get a $300 deduction. And if you're itemizing, if you're giving a cash donation, check, credit card, all count, as in like not stock or land or anything like that, to a public charity, you can deduct a contribution of up to 100% of your AGI. In 2019, that was 60%. It was 50% in 2018. So that's a big jump. So you may want to look at giving to donor advised funds. There's some things like that to take advantage of that. So that's a great one to watch out for in 2020. And you still have about 6 weeks to make some charitable contributions for 2020 year. As we talked about, SALT limitation, $10,000. One thing to note is starting in 2019, Virginia stopped limiting your SALT deduction to $10,000. So if your real estate taxes are $15,000 and your car taxes, as those of us in the Commonwealth of Virginia know all about, are another $1,000, you get to deduct all that on your Virginia return, even though you're capped at $10,000 on your federal return. So just watch out for that. That's was a nice change in 2019 in Virginia. So now let's talk about retirement plans. There's been a lot of changes in retirement plans how it relates to COVID-19 relief. Most of you, I'm sure, know you do not have to take a required minimum distribution in 2020. I just got an email today where somebody said, here's my IRA balance as of last year. Can you tell me quickly what my RMD is for 2020? I said, yes, I can. 0. I don't even have to do math. So I like those answers. Now, it's currently scheduled to go back in 2021. There's some chance that could be extended. I don't really think so. But, watch out for that. So if you don't need the money, I'm advising all my clients not to take that out. There's no point. Let's defer that as long as we can. If you did take money out of your IRA, you do have 60 days to put it back. So there was a special rule if you took it out earlier in the year, but that rule was over as of August 31st. So if you took one out, let's say October 1st, you have 60 days, and that's 60 calendar days. Do not be a day late. The IRS does not play with this one. If you miss it, you're done. So I always say err on the side of caution, do like 55 days so you know you're not an issue. But that would allow you to put the money back and not pay taxes. If you took a loan from your IRA, well, not from your IRA, you can't do that, from your 401k, they did defer loan repayments for up to a year. So that's not going to hit that many people, but it's great. The big one that I'm seeing people is the coronavirus related distributions from a 401k or IRA. You can take up to $100,000 out, and your 10% penalty doesn't apply if you're under 59.5. So that's a nice little benefit. Still subject to income tax. However, you can have the tax ratably over a 3-year period. So if you took out 100,000, that's 33,333 over a 3-year period, plus another dollar to a couple years. And so you get to defer some taxes while taking money now. And you have 3 years from the date of distribution to pay that money back. So if you just kind of need a short-term loan and you can put the money back because it's, the more you can keep in a retirement plan, the better. You can put that money back. You just amend your returns to offset that income that you reported in prior years. So that's a big one.
Marnette, so the requirement to be able to take that up to 100,000 without paying the 10% early withdrawal penalty, to be eligible, you have to be.
It has to be a coronavirus related distribution. Pretty broad. You don't have to have had COVID-19 or the Rona, as I like to tell my niece, I call it. You just have to have been impacted by it. It's a pretty broad definition. And pretty much everybody is going to qualify unless, let's say, your income is up dramatically in 2020, which there are a few lucky people out there where their income is up. That would be probably a harder sell. But if at the time you took it out, you didn't know what your income was going to be, or your income was down at that point, I think this is pretty much going to be a blanket approval. There's going to be little backlash on anybody taking money out, like I said, unless your income's up appreciably. I don't think there's a whole lot that anybody's going to argue about that one.
Good to know. All right, thanks, Marnette. I'm going to get now into a bit of the estate tax planning and how we should be advising our clients with regard to any potential changes in the estate tax exemption or the rate or some other proposals that we mentioned. And so as I was starting this, I found myself going back and just trying to summarize how did we get to where we are now, because really Biden has technically only said in regard to the estate tax that he would like to return to historical norm. And so whether that means pre-2017 tax levels of the 5 million and 40% estate tax rate once you exceed the exemption, or whether that is going back to what it was in 2009 to the 3.5 million and 40% rate. That's really unclear. And as we said, probably it's not going to be the top of anybody's agenda, the so-called death tax, with everything else that's on the plate. But regardless, this slide just summarizes kind of the roller coaster of uncertainty that we've been operating under since the 2001 Tax Act, with the gradual increasing in the exemption. Of course, we had that period of time where the gift tax exemption was decoupled from the estate tax exemption. That made for a lot of fun planning. We had the repeal of the state death tax credit, and then the introduction of portability, which was taxpayer friendly, where you could elect to transfer the deceased spouse's unused exemption to the surviving spouse, which was, I had almost forgotten about the 2010 Tax Act, but of course we all remember 2012 and the flurry of planning that we were all doing, and with the anticipation that the 2-year extension of the Bush tax cuts that under the 2010 Tax Act that Obama negotiated was scheduled to sunset at the end of 2012, and we were going to be going back to the potentially the 1 million exemption and the 55% rate. And as I'll get to the next slide, that a lot of clients did implement a lot of planning and gifting, and then lo and behold, with the 2012 Tax Act, the exemption was made permanent at 5 million and 40% rate. We never ended up reverting back to the 1 million exemption or that higher rate. So all that planning was somewhat for naught. And so that's why a lot of our clients now are treading carefully, and they're looking to their advisors to, again, just help them assess, what are the risks of these potential tax law changes, and what sort of planning should I be considering now. Like we say, thank goodness that there's no rush to get anything done before year end. But the changes under the 2017 Tax Act, as we all know, in terms of the doubling of the estate tax exemption, are due to sunset in 2026. So that just gives us more time to talk with clients and to decide what's going to be the best course in terms of taking advantage of that increased estate tax exemption before it expires in 2026 or sooner. This slide I'm not going to spend a lot of time on. It's just some of the other more progressive proposals and tax law changes that keep it on your radar, but not anything we feel that is really that worrisome in the near term. So so as I said, I mean, we know that the exemption and the changes, the doubling of the exemption under the 2017 Tax Act will be sunsetting in 2026. So for the clients who have already, in anticipation of that blue wave that was expected and did not materialize, we have clients who have already started like getting a dynasty trust in place so that they can make a gift and utilize that excess exemption. The plan was by the end of this year. I don't think that is going to be necessary, as I said, to rush and get that done. But if they've already started the planning and by consulting with their advisors and their financial planner, they've determined that they have it's prudent and that they'll still retain enough funds for themselves for the rest of their lifetime. There's no reason not to proceed with that current planning. A couple other things we have noted here: the anti-clawback regulations very clearly provide that to the extent that you use that excess exemption before it reverts back to the from the 10 million index for inflation back to 5 million index for inflation, and then you were to die after it sunsets back to the lower 5 million amount, that it's not going to be counted against you, that the fact that you've used 11.7 or whatever million, but at your death there's only 5-6 million, whatever it is, index for inflation. So no worries about that. And so we do have this use it or lose it time window, and it's mostly for clients who have already used up their exemption prior to the 2017 Tax Act. And so we have this excess amount that we know is going to sunset in 2026, potentially could be decreased sooner. So it really is the use it or lose it opportunity to, again, if you're able to make a significant lifetime gift. And certainly one of the key messages is, and hopefully I think after the 2012 planning that was done, which turned out to be for not. We want to, certainly making gifts and trusts is much better than just making an outright gift, because there are strategies that you can, the grantor or the donor can retain some indirect access to potentially get at those gifted funds if needed. And so I'll talk about some of those strategies. And certainly when we're talking with clients about whether they're going to be making lifetime gifts or how they want to provide for their estate and their inheritance at their death, leaving assets in trust is always it's my kind of default recommendation because of the additional asset protection that you get versus just leaving it outright beneficiary. So I think that the team approach and the advisors, the attorney, the financial planner, the accountant, the investment advisor, us, it's really important that we all work together and have a coordinated approach. And really, doing the financial projections and to just determine the extent that the client can or does have the capability of making lifetime gifts to take advantage of this excess exemption before it disappears.
Melinda, do you think that's going to go away? I mean, in your crystal ball, where, do you think we're going to be down more in the 5 million range, or what's if Congress were to ask you, not that they ask you or me, it appears, but where do you think we're going to be?
Well, of course, it automatically sunsets in 2026, and so Congress would have to do something and actually enact legislation and agree to do otherwise. And so, because I currently don't have a lot of confidence in that happening, I think it'll probably come down to the last minute. If there were to be any affirmative action. Otherwise, I think it is most likely we're just going to see that it sunset in 2026 and 5 million seem an index for inflation. Certainly under the Democratic administration, I think that's where they would like things to end up. But again, this uncertainty that we've been operating under with regard to the estate tax exemption has been for the last 20 years. We've never really been able to say for sure what the future law might be. And so that's why retaining flexibility and is extremely important. And we can do that most efficiently by using trusts. And so I'm not going to spend a lot of time going through the technical kind of ins and outs of these different strategies. I'm sure, but you're all familiar with SLATs, spousal lifetime access trusts, which are basically just irrevocable trusts that are structured as also dynasty trusts to continue for the for the descendants. But a grantor spouse can also be a discretionary beneficiary, and so that is one of the most common ways of the donor, the grantor, being able to at least as long as they stay married, and of course so the risk of divorce is can be an issue, but and so that's why it's important. I've noted here you want to include the floating spouse clause so that you can retain some flexibility there with regard to the risk of divorce. And even if you're planning for a single person, a single client, if they were to then get married, then that floating spouse clause would kick in. But so that way, with the spouse being a discretionary beneficiary, as most of us know, the grantor is not completely giving up access to the gifted funds. The grantor spouse can be also the trustee and have the ability to make discretionary distributions to themselves based on ascertainable standard of health, education, support, and maintenance. We usually say without taking into account the spouse's other resources or income. An important thing to remember is that because the grantor spouse is a discretionary beneficiary of the SLAT, the gift splitting election is generally not available because you cannot ascertain what the surviving spouse's share of the gift is. So the other issue to look out for, which I think most people are familiar with, is if you're going to be have each spouse creating a SLAT for the other, which is a common planning for married couples. You want to avoid the reciprocal trust doctrine by just varying the terms in between the two trusts slightly, so that the IRS just doesn't uncross them and say that you really created this trust for yourself and you're really the beneficiary, not your spouse, and so therefore the trust is still included in your estate. The one thing I want to note here is also if you're looking at creating two SLATs, one for each spouse, when we're looking at particularly for couples who have assets under 10 million, you're gonna be usually better if rather than each spouse creating a SLAT and gifting 5 million to each SLAT, you're not going to be really accomplishing anything, because when the estate tax exemption reverts back to 5 million, the IRS is just going to soak up that first 5 million, and you won't be using your excess exemption. And so it would be better in that example for just one spouse to gift the entire 10 million to a single SLAT, and then you're ensured that that spouse is utilizing the excess amount over the 5 million index for inflation, and then the other spouse is still going to retain their full exemption. And so that the math is going to work out better if you do it that way. Another technique to just again retain flexibility and give the grantor some potential of access to the gifted funds and trust is to allow the trustee to make loans to the grantor without adequate security. That's one of the most common provisions we include to make grantor trust for income tax purposes, which is usually the preferred way of structuring a irrevocable lifetime trust. Interest, typically you want to still provide that interest would be payable on that loan, but it would be at the very, very, very low AFR rate to avoid any adverse income tax reporting. So that's just another way if the grantor would need access to the gifted funds to build that flexibility into the trust document. If the grantor is not married, then just creating a standalone dynasty trust for the children and descendants or whatever other intended beneficiaries. There's a new technique that is referred to as a SPAT. And so if you're going to do a SLAT, you can also make it a SPLAT. And if you're just going to, if you're not married and you're just doing a dynasty trust, you can make it what we call a SPAT. And I'm not going to get into a lot of the technical details on that. I'm referring you to an excellent article written by Jonathan Blattmacher in the February 2019 issue of the Estate Planning Journal. But basically it's again to retain the grantor's ability to still have some access to the gifted funds. You grant an individual, can't be the grantor, and it shouldn't be a current beneficiary of the trust, a lifetime special power of appointment to be held in a non-fiduciary capacity, to basically add the grantor back as a beneficiary to the trust, but as a part of a larger class of beneficiaries, such as all descendants of the grantor's grandparents. So again, this SPAT technique is discussed in detail in the Blattmacher article, which is entitled SPATs, a flexible asset protection alternative to domestic asset protection trusts. And I also wanted to mention Jonathan Blattmacher and Marty Shankman are hosting a webinar later this afternoon at 4 p.m. And I know they'll be talking in more technical details about this SPAT technique. And so you can go to Marty Shankman's website at shankmanlaw.com and register. And I would highly recommend doing that, because you'll learn a lot. I've heard a couple of their webinars over the last couple of weeks, and always good stuff. The other planning technique I have here is the domestic asset protection trust, and there are issues with that, and that's what makes the SPAT more attractive, because some states, including Virginia and Delaware, Nevada, Alaska, they do have domestic asset protection trust statutes which allow the grantor to create a self-settled asset protection trust. That the grantor can be a discretionary beneficiary, but the catch is you have to have an independent trustee. So the grantor, of course, can't be a trustee and can't be a related trustee. And the trustee has to have a nexus to a DAPT-friendly state. So if you're going to create it in Delaware or Nevada or Alaska, you need to have, be working with a trustee or trust company in that state. And the other thing to look out for with domestic asset protection trusts is the issue of fraudulent transfers, which can also get us in trouble as advisors, particularly as the drafting attorneys. So anytime we're implementing or recommending a domestic asset protection trust, we want to make sure that the grantor is not currently being sued or expecting to be sued, or has any other current creditor issues, because then that would make any transfer to the trust a fraudulent transfer, and big trouble, including for the attorney and the advisor, if that would turn out to be the case. Some other interesting kind of mitigation strategies that I wanted to mention, particularly for clients who, they're going to, these are the higher net worth clients, 10 million and above. Again, they've already used their current exemption. They don't want to miss out on the ability to use this extra exemption that's currently available, because once it reverts back to the lower amount, they most definitely will have a taxable estate. And so they want to take advantage of this special opportunity to make a lifetime gift and not pay any gift tax and get that amount out of their taxable estate. And if they are particularly concerned still that we would see the reduction in the exemption sooner rather than later, particularly in the off chance that the Georgia would go, both those seats would go Democratic, and then we'd have the 50-50 and with the vice president as the tiebreaker. There are some techniques that you can implement as part and make a gift now if a client is really concerned that there would be some potential tax change sometime next year, or that would the off chance be retroactive back to January 1. Again, we don't think that's likely, but there's a couple methods here where you can kind of do this wait and see gifting, and then pending the outcome of the election and any anticipated tax law changes, you can decide whether or not you want to really make it a fully completed gift or not. And so one method, which I know Jonathan Blattmacher and Marty Shankman will likely be talking about during the webinar this afternoon as well, is using a qualified disclaimer, which, if you want to make a gift to an irrevocable slat or dynasty trust now, the trustee or the beneficiaries have the ability to execute a qualified disclaimer under Section 2518 of the Internal Revenue Code and whatever is required under applicable state law. And generally that needs to be done within 9 months of the transfer. And so that basically gives you 9 months to decide, do I want to make this a completed gift or not? And then if things don't turn out and you want the funds back, then you make the trust agreement would say, in the event a qualified disclaimer is made, all the gifted funds just revert back to the donor. I won't spend too much more time on these other two strategies here. Using a lifetime Q-tip trust similarly would give you time, because you don't have to make the Q-tip election to decide whether or not you want to treat it as qualifying for the marital deduction or not, until the gift tax return is due. So that would give you potentially until October of next year to decide whether or not you want to make that election. And then the last point is doing an installment sale to a grantor trust, and then just with a stroke of a pen, kind of before midnight, you could just decide to forgive that note, and which would make it all a completed gift to the trust. I know we're just up about to the top of the hour. It's just some other quick estate planning tips here in general. Of course, you want to try and take advantage of gifting assets that are depressed valuations right now due to the current economic and COVID environment, to leverage the gift tax exemption and shift that future appreciation out of the grantor's estate. But just be mindful here that the donee does take the carryover basis in the gifted property. So we again, trying to build in maximum flexibility, we can include some special provisions in the trust agreement to either grant a beneficiary a testamentary general power of appointment so that the assets are included in the beneficiary's estate, and then get the stepped up basis. The grantor can also use the swap power to substitute assets of a higher basis for those low basis assets. And I guess the last couple things I'll say on this slide here is, this is a good time just to review estate planning documents. A lot of clients who have still their documents were done maybe 10, 20 years ago, they're still providing for the automatic funding of the credit shelter trust at the first spouse's death, which is really not needed for a lot of clients right now, given the higher exemption amount. And it's actually a disadvantage because you lose out on potentially getting the stepped up basis in those assets at the surviving spouse's death, because those assets are not includable in the surviving spouse's estate. So we're updating a lot of clients' documents to not provide for the automatic funding, and instead just what we call a one lung Q-tip trust, just directing all of the assets of the first spouse's death to a Q-tip marital trust. And then you can kind of do similar to a disclaimer type planning, a wait and see, and depending on what the exemption amount is at the first spouse's death, decide how much you want to make the election of that Q-tip trust to qualify for the marital deduction and how much you don't. And so again, that's going to really, for most clients, provide the most flexibility. And so our final message, and before we try and, Marnette, I don't know if you saw any questions come in, but of course, the tax tail shouldn't wag the dog. But there's a lot of non-tax advantages, like I mentioned, to gifting and making creating trusts for your beneficiaries and providing for your estate. But as I mentioned, it's really important. It's key that, to work with a team of advisors so that you can really have a comprehensive analysis and projections of your current situation, and then so you can really decide on what's going to be the best approach going forward.
Yeah, and Melinda, I mean, I agree with that 100%. If any of my clients are on here, I always say, well, I'd love to say your tax situation should, be the driving force for every decision you make. Clearly, it's not. Taxes aren't the most important thing in the world, but they are something to keep in consideration. You need to work with your estate planning attorneys, your financial planners, and everybody else out there to come to the best decision for you, because each one component, isn't the only thing to consider.
Yeah, and I see that we did get a question, which you answered, Marnette. Somebody asked, does Virginia have a domestic asset protection trust statute? And yes, it does. It's not as well established as other states like Delaware or Alaska or Nevada, South Dakota, but we do have it, and so that is one arrow in our quiver that we can use, when appropriate. I don't see that we have any other unanswered questions. So with that, thank you all for joining us. And like I said, we will be sending out a link to the recording as well as the slides and the other materials I mentioned, hopefully tomorrow. And thank you all for joining us. Be safe and have a good rest of your afternoon.
Bye, everyone.